Let's talk about asset allocation, because you said 10 to 15% in gold and silver. But
Yes.
what happens with the rest? Because a lot of people have this tendency, Abhishek, to run after things that are doing well. So if, for example, gold is suddenly running up, then they'll say, why not put more money in gold? And the entire asset allocation goes for a toss. Is there I know there are lots of thumb rules to follow, but incidentally, when we were talking about, you said that asset allocation goes back to the 4th century BC.
Right, right. So I was just reading about asset allocation recently, and I came across thousands of years back, Jewish came with a literature called as Talmud. So what does that means is they said that divide your money into three asset classes. One is physical, where you buy gold, real estate. Second is you buy businesses. So probably you invest into equity, you invest into mutual funds. Third is you buy debt products or products which are liquidable. So this they wrote thousands of years back, and they back tested it at that time. So what they came out with this result was that if you follow this method of one third into physical, one third into commodity, one third into your liquidable assets, then out of 9 out of 10 years, you will be in the top 25% returns. The only important thing is you have to rebalance your portfolio every single year in a disciplined manner. That means you have to sell whatever has gone up. You have to sell your winners and buy your losers. If you keep doing that, in 9 out of 10 cases, you will be in the top 25% asset allocation. Now, this Talmud portfolio was also taken ahead by Markowitz, who won the Nobel Prize in 1990. The same portfolio was also referred by Roger Gibson in his 1998 book called as Asset Allocation. You know, asset allocation has five key takeaways. I would like to discuss that because people always they listen about asset allocation and they keep it on the back seat while investing, because people get more interested in investing in asset classes which have performed better in the near future. There are five key takeaways for the asset allocation thing. The first thing which came after the Markowitz theory is your return and risk both are calculatable. What does that mean? Return is very easy to calculate. You put 100 rupees, you get 200 rupees, you say, I got 100 rupees return. But you need to calculate your risk as well. How do you calculate your risk? Like we said earlier, through your standard deviation. The second key takeaway of your asset allocation is that more risk always doesn't mean higher return. After a certain point of efficient frontier, even if you keep taking higher risk, your returns will not increase in the similar linear fashion. The third key takeaway is adding asset class into your portfolio will reduce the risk but not reduce your return. So always have about 3 to 4 asset classes in your portfolio. Fourth thing is rebalancing is very important. Rebalancing is it's like in your employment, every month you get salary, and at the end of the year you get a bonus. So if you do rebalancing, rebalancing will give you a rebalancing bonus after a longer period of time. Also, rebalancing helps you to stay disciplined. You know, in bookish knowledge, we always hear that you should buy, low and sell high. But we are not able to do that because we don't have a perfect asset allocation in place. So asset allocation really helps you to stay disciplined when you are investing in your journey.
Okay, so some key takeaways of asset allocation, and those points are well made, particularly the one when it comes to averaging both on the upside and on the downside. It's not the easiest thing to time the market, and not many people can. So follow a simple asset allocation strategy, as Abhishek is suggesting. Let's talk about a scheme or category of mutual fund schemes that is doing exactly this without you having to churn too much. And this is multi-asset. We speak about it, incidentally, Abhishek, whenever we speak about gold, but I don't think that that should be the case. And I know that mutual funds have different interpretations to how they do this multi-asset strategy. So let me ask you this. If we were to look at the key functionality of these schemes to say return maximization would be one. The second would be absolute balancing of asset classes and shifting between asset classes. And the third being capital protection. How would you describe these three principles and talk about schemes in the same category?
Right. So one very good category which mutual fund has evolved it into is called a multi-asset allocation fund. How did this evolve? Earlier, there was 100% equity where 100% of the money was getting invested into equity. Second, what came is a balanced fund. What was balanced fund doing? 75% equity, 25% debt. The fund got evolved more, the category got evolved. They came up with a balanced advantage strategy. What it used to do is it used to play between debt and equity and say whenever the equity is on a higher side, they would go up to 30%, 40% on the equity level. Now, after that, this category has evolved further and they have come up with a category called as multi-asset allocation. What does multi-asset allocation means? You have to have minimum 3 asset classes in your portfolio with a minimum 10% asset allocation to all these 3 asset classes. We will discuss 3 mutual funds of this category. One is DSP mutual fund, second is White Oak mutual fund, and third is ICICI. ICICI is one of the leaders in this segment. They are managing 52,000 crores in today's multi-asset allocation fund. The fund is managed personally by Naren and 2 other fund managers. What does this fund try to do is they try to have a 65%, more or less 65% equity exposure. Second is they try to have some exposure on the debt side. Third is they have a exposure on commodity side. So if you see the asset allocation today, they have an equity portion of 52%, debt portion of 35%, commodity is about 12%. So they have divided into the 3 asset classes. The entire agenda of the fund is more or less to have lower risk as compared to Nifty and deliver better returns as compared to Nifty 50 by doing the asset allocations. Now, what is the difference in this fund and the other 2 funds is that of the taxation. They try to mirror an equity taxation, which means they at any point of time have to keep 65% of their funds into equity and then probably they try to hedge it with the options. But the first agenda, because they cannot go below 65% to get an equity taxation, they have to always try and chase the equity side more as compared to chasing the other asset classes. DSP and White Oak comparatively are really going by the T of being a multi-asset allocation fund. What they have done is first, in terms of taxation, they don't follow an equity taxation strategy. They follow a taxation strategy which states if you have more than 35% allocation in equity, you can put your money for 2 years and have a 12.5% taxation. So first, they are stress-free in terms of keeping 65% allocation in equity. Now, how does White Oak does is White Oak has 31% in equity, 56% currently they are having in debt. They are having about 4% in commodity and they have put in real estate and REITs and invest as 7.5%. So they are particularly trying not to beat the market, but to be a pure asset allocation play where having 3 asset classes. One is equity, second is debt, and third is real estate in their portfolio. At the same time, DSP is doing something different. What DSP is trying to do is because they are master in picking foreign equity, they have an Indian equity exposure of about 37%, foreign equity exposure of about 21%, debt is 25%, and gold and silver is about 15% in their portfolio. They have one of the wonderful names in the foreign equity side. They have GE, they have Amazon, they have Nike. They're one of the funds which is DSP Value Fund. Still holds Berkshire Hathaway as a share. So because they are, very good in picking foreign stocks, they have a foreign flavor in it. White Oak is good in, picking, Prashant Khemka is good in picking the real estate side. So they have a flavor of real estate in them. ICICI multi-asset allocation at the same time is having more towards the equity side because Naren is a pure equity player in its investment strategy.
Yeah.
You look at the standard deviation of all three products is very different. ICICI multi-asset allocation fund has a standard deviation of about 12%, which means almost like an equity fund. Nifty has a standard deviation of about 13-14%, and they are having a standard deviation of 12%. White Oak has a standard deviation of only 4%. Its 1 year return of White Oak is 15%, yet it has a standard deviation of only 4%. So White Oak is really, living by the tea.
Okay, so you've actually elucidated that point. You want to very quickly tell me what the standard deviation for DSP's multi-asset fund is?
8.54%.
Okay, so that kind of bears it out, right? Because the objective of each of these schemes is slightly different. So when you're investing in this category as well, which a lot of people tend to do because they say these will give me gold allocation, it's not always necessarily true. It could actually be true, but it's not always necessarily true. And I hope that we've given you some perspective, viewer, on how to look at these schemes and this is really true. It could actually be true, but it's not always necessarily true. And I hope that we've given you some perspective, viewer, on how to look at these schemes and this category. Abhishek, thanks so much for joining me today. Absolute pleasure having you on the program.
Thank you so much.
All right, now